All right, so let's dive into something that I bet's been on all our minds lately, the stock market.
Yeah.
And you know what everyone's wondering?
What it's going to do next.
Yeah, exactly. I mean, we just saw the Dow drop for 9 days straight.
Right.
9. That hasn't happened since
1978.
Yeah, 1978. So to help figure out where things might go from here, we are taking a deep dive into this article from mapsignals.com called "This Ultra-Rare Oversold Signal is Undefeated."
Okay, I like it.
Catchy title.
Yeah, definitely.
And it was just published on December 26, 2024. So it's got the latest data.
Very cool. Yeah.
And the article claims that there's this signal that's, get this, never been wrong.
Oh, wow.
When it comes to predicting market gains.
Seriously.
Yeah. Plus, it dives into the whole Santa Claus rally thing, which I'll admit sounds more like something you'd hear on like a holiday special than a financial deep dive.
Well, I mean, sentiment plays a role in the market too, and that often ties into those seasonal trends.
Right, exactly.
But before we get to Santa, let's unpack this whole undefeated signal.
Okay, yeah, let's get into it.
All right.
So the article starts by talking about the Dow Jones Industrial Average.
Right.
You know, the DJIA falling for 9 straight days.
Yeah.
Like, is that even normal?
It's definitely unusual.
Okay.
Yeah, you'll see this a lot, but DJIA stands for Dow Jones Industrial Average.
Right.
It tracks 30 of the biggest U.S. companies, so seeing it drop for that long is a sign that a lot of investors are feeling pessimistic.
Yeah, for sure.
But here's where it gets interesting.
Right.
Historically, this kind of extended drop often leads to a pretty significant rebound.
So maybe this recent downturn isn't something to panic about?
Well, let's look at the data.
Okay.
Since 1942.
Okay.
There have been 17 times when the DJIA has fallen for 9 consecutive days.
Oh, wow.
And each time, the market bounced back.
Each time? Really?
Uh-huh.
What were the gains like?
So the article says that after 6 months, stocks were up an average of 12.7%. And after 12 months, the DJIA gained an average of 18.3%.
Wow. Okay.
But here's the kicker.
Okay.
In investing, we talk about hit rate,
Right.
which basically means how often a signal accurately predicts what happens.
Okay.
And with this 9-day losing streak, the hit rate for gains after 6 and 12 months is 100%.
100%. No way. Is there ever anything that certain in the market?
Well, it's based on past performance, of course, but it's still a pretty remarkable track record.
Right.
All 17 times the signal has appeared.
Okay.
It's been followed by gains.
So you're telling me there's hope after all?
It seems that way.
Maybe even some serious gains on the horizon.
Well, that's what the historical data suggests. It's like the market's taking a deep breath before jumping higher.
Okay, so this undefeated signal is giving me some cautious optimism.
Okay.
But the article mentions another interesting point.
Okay.
A huge surge in trading volume on December 20th.
Right.
Apparently over 1,700 stocks and ETFs had unusual activity.
Yeah, and that kind of volume spike is worth paying attention to.
Yeah.
It often indicates that the big players, institutional investors, are making moves.
Oh, okay.
They're the ones with the resources to really shift the market.
So it's not just like a bunch of day traders causing this frenzy.
Not usually.
Okay.
When you see that kind of volume across so many different stocks and ETFs, it's a sign that something bigger is going on.
Gotcha.
And the article focuses on one specific example that day, the SPDR S&P 500 ETF Trust.
Oh.
Or SPY.
Hold on. The SPY,
Yeah.
just so I'm clear, that's basically a basket of the 500 biggest U.S. companies, right?
Yeah, exactly.
Okay.
It's often used as a gauge for the overall market's health.
Got it.
Okay.
So what happened with the SPY on that crazy high volume day?
So it gained 1.2% while trading over 125 million shares. Now, you're probably wondering why that's significant.
You know me so well.
Well, since 2015, there have been 66 instances where the SPY gained at least 1% with that kind of trading volume.
Wow.
And what happened afterward is pretty interesting.
I'm all ears.
Okay, so after these instances, the SPY gained an average of 6.2% after 3 months, 11.7% after 6 months.
Wow.
But after 12 months, the gains were even bigger, an average of 21.5%.
That sounds promising, but was it as consistent as that undefeated signal we talked about earlier?
It's not a perfect 100% hit rate,
Okay.
but it's still a strong indicator.
Okay.
When you combine that price action with that level of volume, it suggests underlying strength in the market.
So we've got this rare 9-day losing streak that's historically been followed by big gains.
Right.
And we've got institutional investors making moves, which also seems like a positive sign.
Yeah.
Okay, I'm starting to feel a little better about my portfolio.
It's certainly a more nuanced picture than just looking at the recent downturn.
Right.
But there's another element the article brings up that we should probably discuss.
Okay.
The so-called Santa Claus rally.
Ah, yes, the holiday magic we talked about earlier. So is this really a thing or just some Wall Street folklore?
Well, it's a recognized seasonal trend.
Okay.
It refers to the tendency for stocks to do well in the last week of December and the first few days of January.
Right.
And the article mentions that a massive $22.9 billion flowed into the SPY ETF on December 23rd.
Wow, that's a lot of money pouring in right before the holidays.
Yeah.
So what's driving this rally?
Yeah.
Is it just holiday cheer or is there something more to it?
It's probably a combination of factors.
Okay.
Some theories suggest it's tied to year-end bonuses being invested.
Oh, that makes sense.
Optimism about the new year.
Yeah.
And lighter trading volume that can magnify price movements.
Okay, so maybe a mix of practical factors and a dash of holiday spirit.
Right.
But does that really mean we're in for a smooth ride into the new year?
Well, it's important to remember that these trends and signals don't tell the whole story.
Right.
The market is influenced by a lot of things.
For sure.
And predicting its moves with absolute certainty is impossible.
Of course, yeah.
But this data does give us some interesting points to consider.
Right. So let's talk about some of those other factors.
Okay.
What else might be influencing the market as we head into the new year?
Sure.
Because let's face it, things have been pretty unpredictable lately.
You're not wrong about that.
No.
So to help you understand what might be coming next,
Okay.
let's look at some of the potential headwinds we need to be aware of.
Okay, so let's get real.
Yeah.
What are some of the things that could derail this potential market upswing?
Well, for starters, the global landscape is pretty shaky right now.
Yeah.
Things like geopolitical events, changes in interest rates,
Okay.
inflation,
Right.
and even things we can't predict could throw a wrench into things.
So it's not all candy canes and sugar plums after all.
I wouldn't go that far.
Okay.
But we need to be realistic about the risks as well as the potential rewards.
Okay, I'm ready to hear the not-so-fun stuff. Let's break down some of those potential risks.
Let's do it.
Yeah.
Well, we were just talking about how unpredictable things have been globally,
Yeah.
and you're right, that has a huge impact on the markets.
Right.
Things like trade tensions or unexpected political events can really spook investors and cause some serious volatility.
Yeah, it feels like every time I turn on the news, there's some new crisis brewing somewhere in the world.
Right.
How am I supposed to make sense of all that when I'm trying to figure out what to do with my investment?
It's definitely a lot to take in.
Yeah.
And it's important to stay informed, but remember, we're not trying to predict the future here. Just trying to understand the potential risks and how they might affect the market.
Okay, that makes sense.
Yeah.
So besides all this geopolitical stuff, what else should we be worried about?
Well, interest rates and inflation are two big ones.
Okay.
Central banks around the world are trying to get inflation under control.
Right.
And the steps they take, like raising interest rates, can have a ripple effect on the markets.
Yeah, I'm hearing you on that.
Yeah.
It seems like every time the Fed even hints at raising rates, the market goes haywire.
It's because higher interest rates can slow down economic growth.
Right.
And that can impact corporate earnings,
Uh-huh.
which can then lead to a market correction.
Okay, so it's this balancing act between these positive signals from the past and all these lurking risks in the present.
Yeah.
How do we make sense of it all and make smart decisions?
That's the million-dollar question, isn't it?
Yeah.
There's no easy answer.
Right.
But sticking to some basic investing principles can definitely help.
All right, I'm ready for a crash course in Investing 101.
Okay.
What are some things we should keep in mind?
Well, first and foremost, diversification is key.
Right.
Don't put all your eggs in one basket.
Okay.
Spread your investments across different types of assets, different sectors, maybe even different parts of the world.
So I'm hearing you on diversification.
Yeah.
But how granular should we get?
Okay.
Are we talking about different stocks within a sector?
Okay.
Or totally different types of assets?
Both, actually.
Okay.
Think of it as building a strong foundation for your portfolio.
Okay.
You want a mix of stocks, bonds, maybe some real estate commodities even.
Okay.
That way, if one area takes a hit, your entire portfolio isn't wiped out.
So spread the love.
Right.
Spread the risk.
Exactly.
Got it.
Yeah.
What else should I keep in mind?
Stay informed.
Okay.
Keep up with what's happening in the economy and geopolitically.
Yeah.
But don't just rely on headlines.
Yeah.
Do your own research on companies and industries that you're interested in.
So be curious, dig deeper.
Yeah.
Don't just blindly follow the crowd.
Exactly. And perhaps most importantly, remember that investing is a marathon, not a sprint.
Right.
The market will always have its ups and downs.
Right.
Don't panic and sell everything when things get rough. And don't get greedy and go all in when things are going great.
Right. So stay calm.
Yeah.
Stay the course. And try not to check my portfolio every 5 minutes.
That's the idea.
Okay.
Focus on your long-term goals and try to tune out all the noise.
Okay.
And remember, if you're ever unsure, it's always a good idea to talk to a financial advisor who can help you create a strategy that aligns with your individual circumstances.
Okay, that all makes sense.
Good.
So we've got these historical trends suggesting a potential upswing, but we also need to be aware of the risks.
Yes.
Make sure we're diversified, informed, and thinking long-term. Is that the gist of it?
That's a great summary. Okay. It's all about balancing optimism with realism.
All right, so let's bring it back to the article we started with.
Okay.
Out of all the information we've discussed, what stands out to you the most? What's the one thing you think is most important for our listeners to understand?
You know what fascinates me?
What's that?
Is how this article is a perfect example of how the market can be both predictable and completely unpredictable at the same time.
Yeah, that's a head-scratcher for sure.
Right. We've got these historical trends like the undefeated signal, which suggests a certain level of predictability.
Right.
But then you've got all these other factors, these global events and economic trends that could throw everything off course.
It's almost like the market has a personality. A little bit Dr. Jekyll and a little bit Mr. Hyde.
That's a great way to put it.
Yeah.
And I think that's why it's so crucial for investors to understand both sides of the equation.
Okay.
The historical trends can be incredibly valuable.
Right.
But they don't exist in a vacuum.
Yeah.
We need to be aware of the bigger picture, the forces that are constantly shaping and reshaping the market landscape.
So we can't just rely on the past to predict the future.
Right.
We need to be aware of what's happening right now and how those current events could influence things.
Exactly. And that's what makes investing so challenging, but also so rewarding. It's like solving a puzzle where the pieces are constantly changing.
Okay, so puzzle pieces, constantly changing. Got it.
Yeah.
So besides everything we've already talked about, what are some other factors that might influence the market in the coming months?
Sure.
What are the puzzle pieces we should be keeping an eye on?
Well, earnings season is coming up soon.
Okay.
And how companies perform over the next few months will definitely impact investor sentiment.
Yeah, that makes sense.
Strong earnings reports could bolster the market.
Right.
While disappointing results could send things in the other direction.
Right. Those quarterly earnings reports are always a big deal. It's like getting a report card on how companies are doing.
Exactly.
Yeah.
Exactly.
What else is on your radar?
Well, the energy crisis in Europe is still a major concern.
Okay.
And it's hard to say how it will ultimately impact the global economy.
Right.
Energy prices have been volatile, and that uncertainty could spill over into other markets.
So energy prices, geopolitical instability, those are big ones. Anything else we should be thinking about?
Well, here in the U.S., the political landscape is always something to watch.
Right.
Midterm elections are coming up next year.
Yeah.
And any shifts in the balance of power could have implications for economic policies.
Right.
Which, as we've discussed, can definitely impact the markets.
True.
Yeah.
The political winds can blow the markets in one direction or another.
Definitely.
Yeah.
For sure.
So it seems like we have a lot of potential catalysts for market movement on the horizon, both positive and negative.
Right.
It's almost like we're at a crossroads, with the past pointing one way and the present pulling us in another direction.
That's a great way to put it.
Yeah.
And I think it highlights the importance of staying informed, being adaptable, and most importantly, not letting fear drive our investment decisions.
Okay. I'm hearing you.
Yeah.
So knowledge is power, stay flexible, and don't panic. Any other words of wisdom for our listeners as we wrap up this deep dive into the market?
You know, I think the most important thing to remember is that investing is a journey, not a destination.
Okay.
It's about consistently making smart choices, learning from your mistakes, and staying focused on your long-term goals.
That's a great reminder.
Yeah.
It's not about getting rich quick. It's about building a solid foundation for your financial future.
Exactly.
And sometimes that means weathering a few storms along the way.
Exactly. But remember, after every storm, the sun eventually comes out.
Right.
And those who are prepared, who have diversified their portfolios, stayed informed, and stayed the course, are usually the ones who come out stronger on the other side.
So don't give up. Don't lose sight of your goals.
Yeah.
And remember that even in the midst of uncertainty, there's always hope for a brighter future.
Well said.
Yeah.
And on that note, I think it's time to wrap up this part of our deep dive.
Great idea. We've covered a lot of ground today.
We have.
But there's always more to learn.
Absolutely. The world of investing is constantly evolving, and there's always a new challenge or opportunity around the corner.
Which is what makes it so exciting, right?
Yes.
It's a continuous process of discovery and learning.
It is.
Yeah, it really does. But, after all this talk about market upswings and potential risks and everything in between, I bet some of our listeners are still feeling a bit uncertain.
I understand that completely.
Yeah.
It's natural to feel a little apprehensive when the market's been as volatile as it has been lately.
Yeah, especially after that 9-day losing streak for the Dow.
Right.
That was enough to make anyone nervous.
It was a stark reminder that the market doesn't always move in a straight line.
Right.
But here's the thing. Those drops, those corrections, those are a normal part of the market cycle.
So you're saying we shouldn't freak out every time the market dips?
Exactly. In fact, those dips can actually create opportunities for savvy investors. Remember that undefeated signal we talked about? That kind of historical data shows that sometimes the best time to buy is when everyone else is selling.
So that's an interesting way to look at it. So what's your advice for anyone listening who might be feeling a bit spooked right now?
I would say this. Don't let fear paralyze you.
Okay.
The market will always have its ups and downs.
Right.
But over time, it has consistently trended upwards. That's why it's so important to focus on the long term, to tune out the noise of the daily fluctuations and stick to your investment strategy.
It's like that saying, time in the market is more important than timing the market.
Exactly. Trying to perfectly time the market is nearly impossible.
Right.
But if you stay invested for the long haul, you're much more likely to ride out those short-term fluctuations and come out ahead in the end.
So patience is key. Got it. But what about those unexpected events, those things we can't predict?
Right.
How do we prepare for the unknown?
That's where diversification comes in. By spreading your investments across different asset classes, sectors, and geographies, you're essentially hedging your bets.
Okay.
That way, if one area of the market takes a hit, your entire portfolio isn't wiped out.
So don't put all your eggs in one basket.
Exactly.
That makes sense. But it can still feel overwhelming sometimes trying to make sense of all this information.
Sure.
And figure out the best way to invest your money.
I understand that investing can seem complex, especially when you're first starting out.
You're right.
But it's like anything else. The more you learn, the more confident you'll become.
So do your research, ask questions, and maybe even talk to a financial advisor if you need help.
Exactly. There are resources available to help you every step of the way. And remember, you don't have to be a Wall Street expert to be a successful investor.
That's reassuring. So to sum up our deep dive today, we've looked at some interesting historical data that suggests there might be some market gains on the horizon, but we also need to be aware of the potential risks, both those we can see coming and those that might catch us by surprise.
Right. It's all about finding that balance between optimism and realism, between understanding the potential for growth and acknowledging the inherent uncertainties of the market.
And through it all, remember to focus on the long term. Stay diversified, and don't let fear drive your decisions.
Well said. Investing isn't about getting rich quick.
Right.
It's about building a solid foundation for your financial future, and that requires patience, discipline, and a willingness to keep learning and adapting as you go.
So to all our listeners out there, whether you're a seasoned investor or just dipping your toes into the market for the first time, we hope this deep dive is giving you some valuable insights and food for thought.
Remember, the most important investment you can make is in your own knowledge and understanding. The more you learn about the market, the better equipped you'll be to navigate its twists and turns and achieve your financial goals.
And as always, we're here to help you along the way. Thanks for joining us for another deep dive into the world of knowledge and discovery. Until next time, keep those minds curious and those portfolios growing.